Okay. So chapter 9, we're going to talk about a lot. So chapter 9 is chock full of what I think might be, passive losses are pretty tough, and gosh, so is rental real estate. But there's some less intuitive items inside chapter 9. So we're going to talk about business expenses and business deductions. That's actually pretty straightforward. We're going to talk about what limits there might be on those. Unfortunately, there aren't too many. We're going to talk about whether there are any special business deductions, and there is one, and we're going to spend a lot of time on it, and it's not in your book. So make sure you pay attention to that part. We're going to talk about accounting periods and methods, and let's get going. Okay, so reporting business income. So we just went through some examples of this idea of passive income or investments from, or income from partnerships or income from S corporations, and those are flow-through organizations. And we talked about flow-throughs in module 1 as well. So business, because business can be organized in lots of ways. So you could be a sole proprietor, corporation, you could be a partnership, an LLC, an LLP, a limited partnership. I mean, there's all sorts of things that you could be organized as. And we already know that the choice of entity can make a difference, right? Under the income shifting model, the choice of entity can make a big difference. And we worked through some corporate versus non-corporate types of business entities. So businesses, we also know, don't have AGI. They don't have dependents. They don't have exemptions. None of those things exist at the business level. So calculating business income is actually, taxable income is actually pretty easy. Gross income minus deductible business expenses. There are a few parts to break down, meaning that's pretty simple, right? Gross income minus deductions. But the variance in the type of transactions that businesses get involved in is much broader. Hi, Eileen. If you go down to Zoom, the bottom left, and you click the stop camera, it will turn off your image. So there's a few parts, more parts to break down. You can have sales, returns, leases, interest, et cetera, et cetera, et cetera. So again, we showed this chart in an earlier chapter, and you can see that corporations, it's just super easy to get to taxable income. Okay, so how do you report taxable income? And you can see business income comes in on line 12. So Schedule C or Schedule CEZ is what is used to report the income of a sole proprietorship. And then you sum it all up, and when you get that net profit from the business, you report it on line 12 of the Form 1040, which is the individual income tax return. That's how business income ends up on an individual tax return. If you look at line 17, rental real estate, royalties, partnerships, S corporations, trusts, those are all other business forms where you take the income off of Schedule E and report it on Form 1040, line 17. So this is how owners collect the amount of income that's reported to them from their flow-through entities. When you think about a corporate investment doesn't have such a thing, right? A corporate investment flows through dividends. So dividends are reported on line 9, and they just are reported in an entirely different way. So here's a Schedule C, just so you can say you've seen one. And don't be surprised if I give you parts of this on your exam to fill out. And you can see part 1 is where you report income, gross receipts, cost of goods sold, line 7, gross income. Part 2 is where all the deductible expenses are reported. And so all these categories that are listed, those are common categories, but it doesn't mean that business expenses are limited to only those types. There's a line down there, 27A, other expenses. If you go to page 2 of Schedule C and you look at line 48, you'll see there's just a bunch of open boxes where you can list whatever other type of business expense you might have that is deductible. So page 1 of Schedule E is where you report income or loss from rental real estate and royalties. So this is where, if you own rental properties, this is where you report the income from each property. So gross rental less expenses. On the back of Schedule E is where you report income from your other business activities, partnerships, S Corps, and LLCs. And you can see that there's a line for income or loss from partnership. That's part 2. Look way up at the top of the sheet. And then within that is passive income or losses, right? So that forces you as a taxpayer to identify the activity, determine whether it's passive or not. If it's not passive, then it gets reported and flushed through on line 17. If it's passive, there's actually a passive loss limitation that you got to collect them on Form 8582 and determine whether you have any deductible passive loss or not. Okay, so let's jump in now to business deductions. So the good news is business deductions are permitted under Section 162 or Section 212. And Section 162 says you can deduct all ordinary and necessary expenses paid or incurred during the taxable year in carrying on any trade or business. Code Section 212 says there shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during the taxable year for the production or collection of income. So those are actually two different things. And we're not going to get too caught up in what those differences are, but notice that the terms are very expansive. All ordinary and necessary expenses are deductible if they're related to business. So ordinary, necessary, and business are the key terms. So deductions for ordinary and necessary. So the courts have had to decide what ordinary and necessary means and what it means to be related to business. So deductions must be directly connected to business activity. Ordinary and necessary means they're conducive to some profit generation, and reasonable in amount means not extravagant. And the other thing that you can't deduct is you cannot deduct an item that requires capitalization. All right, so Mike owns a business that employs his brother Mark. Mark's paid $45,000 in wages by Mike's business. The other employees that work in Mike's business that do what Mark does, they're only paid $30,000 a year. So what is a reasonable amount for Mark to compensate, or for Mike to compensate Mark? And the answer is that's $30,000, not $45,000. As a result, Mike can only deduct $30,000 because that's a reasonable amount of compensation. Anything more than that would be deemed unreasonable. Now, it could be they could justify that extra $15,000. Oh, as it turns out, Mark's better than everyone else that does that job, right? Mark is more experienced, he's faster, whatever it might be. If it could be justified, then it's a reasonable amount. You just have to know that one of the things going on here is that Mark is Mike's brother. So it could be that the extra $15,000 is just a gift from Mike to Mark. Gifts are not deductible. So Carolyn is 100% owner of a corporation. She pays herself a bonus of all the net earnings of the corporation each year. And I think we did an example of this back in Module 1. Maybe that's no good. So she says, well, I'll pay rent to myself in an amount in excess of whatever the market value of the rent is. Or maybe she loans money to the corporation or vice versa, and she pays interest at a rate that's higher than the market interest rate. All these are situations where Carolyn, as 100% owner of the corporation, she's a related party with that corporation. And as a result, she can set the terms of this agreement that are most beneficial to her and have nothing to do with market value. And so what happens is related party transactions are notorious for abuse. As a result, they're also subject to a greater amount of skepticism on the part of the IRS. So you need to be careful when you're taking a deduction for a payment made to a related party, because you can expect it to get higher levels of scrutiny than one to a third party. Okay, so before we get too far along, I want to talk about classifications of business activity. And we're not going to get deep into these definitions, but we've already mentioned two of them. And so before we go any further, we got to break it down a little bit. So we know that you can be passive and active. But you can also classify business activities a different way. They could be a trade or business, they could be for the production of income, or they could simply be a hobby. So now the first two have a profit motive. Trade or business and production of income, those are activities you're engaged in for a profit motive. Whereas a hobby is something you do, and maybe it makes a profit, maybe it doesn't, but you do it more for personal reasons. So one of the classic cases of hobby activities are affluent people that own horses. And maybe they're in the horse business, or maybe they just like to own horses because owning horses is cool. And so they have to be able to break through the hobby classification if they want to be able to recognize losses. In any event, there aren't clean breaks between these. Their definition is beyond the scope of the course. However, there are limitations on these deductions. So that's not really the however I wanted, right? So I think what I wanted to say is, however, trade or business and production of income are subject to the same ordinary and necessary rules. Hobby losses are non-deductible. That's the primary difference. You can't deduct a hobby loss. Okay, so now I want to talk on some limitations against deductions. So remember, broad expansion, 162, 212, all ordinary and necessary. Well, there are always exceptions. Here are the exceptions. You can't deduct expenses that are against public policy. Now, that's a fairly narrow exception. The code is fairly broadly written, but the courts have come in and said, oh, wait a second, who decides what's against public policy? That can't be in the hands of the IRS. So as a result, we're going to make this a fairly narrow exception. And that narrow exception is bribes, kickbacks, and other illegal payments made directly or indirectly to agencies, officials, or employees of the government, or an agency of the government. Okay, so those are a very narrow exception. Another one is there's no political contributions or lobbying costs. Now, your book is going to tell you that you can deduct lobbying costs if they're at the local level to change legislation. That's no longer true. Starting in 2018, local lobbying costs also are non-deductible. Fines and penalties are not deductible, right? So an amount paid or incurred, whether by suit agreement or otherwise, to or at the instruction of a government or governmental entity in relation to a violation of law, investigation, or inquiry by such government or entity into the potential violation of the law. Fines and penalties are non-deductible. Again, this rule is changed. It was expanded by the Tax Cuts and Jobs Act for 2018 and forward so that it picks up just about any amount paid. And it used to be that this was a little bit messy, but one of the other rules that's changed is the government now has to provide informational reporting to the individual or company that pays the fine or penalty, explaining to them what part is deductible and what part isn't. Okay, expenses associated with trafficking in controlled substances. So this is a carve out from the Reagan era where say no to drugs was a big deal. There were lots of people making money on drugs, and what happened is when they got caught, they would deduct the cost of the confiscation and all the other expenses they incurred. So what would happen is, yeah, they go to jail for trafficking, but they wouldn't have to pay any tax on all their drug income they had generated all those years. So as a result, the Reagan administration had this law passed where basically it says, look, any business expenses associated with trafficking in controlled substances simply aren't deductible, period, whether they're business or not. But remember, gross income is defined as including a deduction for cost of goods sold. As a result, Congress doesn't have the power to shut down the cost of goods sold deduction. So why does this matter, right? Presumably none of you are involved in trafficking in controlled substances. However, remember that under federal law, the distribution of marijuana for money remains illegal. However, in the state of California, Colorado, Washington, Massachusetts, and a number of states, recreational and or medicinal marijuana is legal under state law. What that means is the marijuana shop that you're buying your weed from can deduct their cost of goods sold, but they are not eligible to deduct any of their other business expenses. So to the extent they pay salaries to their employees, non-deductible. Okay, that's just a cool quirk. So another one that was added by the Tax Cuts and Jobs Act that I think is good tax policy. If you have a settlement or legal fees associated with a sexual harassment suit, and there's a non-disclosure agreement in place around that settlement, you may not deduct the settlement payment or any of the legal fees. So basically, companies or individuals are no longer allowed to hide behind a non-disclosure agreement because if they do, they cannot deduct those costs. So at least the federal government isn't supporting that. So personal expenses are not deductible unless legislatively provided for. So that means personal living or family expenses, expenses for food, clothing, and shelter. These are non-deductible. Now, if this were 503, we dig in on the handful of itemized deductions, things like home mortgage interest, real property taxes, casualty losses. Those things are deductible, but we don't cover those really in here. And of course, capital expenditures are not deductible. And we'll cover more of that later, especially when we get to the next module. All right, so the last thing is expenses associated with tax-exempt income. I don't want to spend a lot of time on this because businesses generally don't get mixed up in this too much, but interest expense associated with an investment in tax-exempt bonds is the classic example. So if I borrow money and I then take that money and invest it in tax-exempt bonds, well, the income that those bonds are throwing off to me is non-taxable, right? It's tax-exempt. But if the expense were deductible, I'd have an arbitrage opportunity, right? I would basically make money by borrowing money and investing it in tax-exempt bonds, even if the yields weren't the same. But if the yields were equivalent, it's just an arbitrage opportunity. So to shut that down, expenses associated with tax-exempt income, the generation, are not deductible. So business expenses deductible, personal expenses are non-deductible. Got it. This creates an incentive to shift personal expenses to business expenses. So if Sally reads the Wall Street Journal every day and it costs her $100 a year, let's say, if that's a personal expense, there's no deduction for that, right? As a result, her after-tax cost, $100. If on the other hand, that's a business expense and she's in the, looks like 22%, sorry, 28% tax, as a result, her after-tax cost is only $72. So what that means is Sally's going to get the journal sent to her office, right? And as a result, try to classify expenses as business or for the production of income, right? So to the extent I can classify expenses as business expenses, I'm going to try to do so because the after-tax cost is likely to be lower. All right, so the tax code is going to try to find various ways to stem taxpayers from shifting the character from personal to business expenses. And sometimes it's through complex rules. Sometimes it's just through a flat-out denial. And this is an area that saw some action in the Tax Cuts and Jobs Act. So you can expect some differences between last year and this year, which means you can expect some differences between the book and what the law is today. Okay, so let's start with mixed motive expenses for which there's a strict measure put in place. Let's talk about uniforms. Okay, so uniforms are only deductible if they're not adaptable to ordinary clothing. So basically, we're going to carve out a very narrow exception and say only for the narrowest exceptions are you going to be able to deduct the cost of your uniform. So Felicia's a newscaster. She's required to wear fashionable suits for her appearances. Now, if Felicia's left to her own, she's going to dress in yoga pants and t-shirts, right? But of course, to be on the news, she has to wear nice suits. Because if the suits could be used ordinarily, they're not deductible. So if a person could wear that suit and it would be considered reasonable to do so in an ordinary situation, that's not deductible. And it's not relevant whether Felicia does or does not wear them in those situations. So since typically a suit that a newscaster would wear is a pretty it's a formal suit, but it's a suit. As a result, it's probably not deductible. Now, whereas contrast that with officer friendly, who's required to purchase his own police uniform. A police uniform is not something you would wear unless you're in the Village People singing YMCA. As a result, that is not adaptable to normal use, and therefore officer friendly can deduct the cost of his uniform. Now, most law enforcement gets their uniforms reimbursed, so neither here nor there. All right. So another mixed motive expense that's simple denial is entertainment. So under the old rules, entertainment used to be deductible at 50%. Now, the entertainment had to be with business associates, the amount had to be reasonable, and that entertainment had to be directly related to or associated with trade or business. So there are directly related rules means that you are having an active discussion during the meeting or it's in a clear business setting. Associated with means it would directly precede or follow a bona fide business discussion. So let's say, for example, you had a meeting with a client and you discuss business at that meeting, and then when the meeting's over, you guys go to the basketball game, right? The basketball game would be entertainment. As a result, you would have deducted 50% of the cost of the entertainment. However, the new rule says entertainment's simply not deductible, period. So it doesn't matter whether it's with a client, not with a client. Entertainment simply is non-deductible now. So starting in 2018. So meals are often part of entertainment. You often hear them described as meals and entertainment. So meals have always been deductible at 50%. So the meal must be reasonable. The taxpayer or an employee must be present, and it must be directly associated with the active conduct of business. And reasonable in this case, again, means not lavish or extravagant. However, the new tax law restricted the deduction for meals. It must now involve an active discussion aimed at obtaining immediate revenue or be in a clear business setting. So what that means is it's no longer enough to have a meeting, then go to lunch. You must have an active business conversation at the lunch. Now, typically by now in a face-to-face course, someone has raised their hand and said, how would the IRS ever know if you've had an active discussion? And guess what? They would never know if you've had an active discussion. Now, typically what happens is you take your receipt, and there's some conversation in the book on documentation, which is important, but on the back of the receipt, you'd list the people that were there, and you'd list the business purpose. You'd say, well, what did we talk about? Done. That's probably going to cover you. So travel meals are still deductible. So if you have to travel out of town, you can still deduct that at 50%. Celebratory meals are deductible at 100%. So let's say you have a year-end party and you cater it in and everyone's invited. Those are 100% deductible. The other type of meal, and I put that in air quotes, I guess you can see me, meal, that is deductible is de minimis. So let's say in your office, they offer bagels on every Friday and everyone goes in and has a bagel or half a bagel or whatever it is. Those are considered de minimis and they're fully deductible. All right. So let's say you drive to meet a client, you have dinner with them where substantial business is discussed, you attend a sporting event, and then you drive home. The meal would be 50% deductible. The sporting event cost would be totally non-deductible entertainment. Let's say you drive to meet a client, you attend a sporting event, and at the sporting event, you discuss business, right? So a basketball game would be a good example, right? Where during timeouts, you talk business or whatever it might be. A sporting event is simply non-deductible entertainment, period. So no deduction for that one. All right, so we talked about some meals that were not subject to the 50% limit. We talked about that one. We talked about that one. Items provided to the public. So if you have a giveaway table at a booth or something, those are 100% deductible. And meals on the employee's premises. I believe we also talked about this earlier. It's down to 50% deductible, and then they're non-deductible starting in 2026. All right, let's talk about mixed motive expenses with a rule-making approach. So travel and transportation for business purposes is deductible. However, that excludes your commuting costs. So we need to break transportation and travel down into two separate segments. Transportation is the cost of getting a taxpayer to and from a business site. That could be airfare, a bus, that could be mileage in your own car, that could be a taxi, an Uber, whatever, a Lyft, whatever it might be. Travel is meals, lodging, and other incidental expenses. Okay, so there's a difference between these because the tax deduction rules are different. So unfortunately, these are magical tax terms, transportation and travel, and we should be cautious about intermingling them. So transportation when you're not away from home. So that's the cost of getting a taxpayer to and from a business site, but not traveling away from home. That definitely does not include the cost of commuting. So one of the ways you typically see that is through mileage. And in 2018, you can deduct 54.5 cents per mile for your business travel. So Mr. Hand drives 14 miles from his house to his office in Ridgemont. And then at noon, he drives 11 miles from Ridgemont to Lincoln to attend a workshop. And then at the end of the day, he drives from Lincoln back to his home. And the question is, what of this is deductible transportation since he's not away from home? All right. So his trip from home to Ridgemont, okay, that's going from his house to his normal working place. That's a non-deductible commute. However, when he goes from Ridgemont to Lincoln, since Lincoln is a temporary work location, he's just going there for the workshop, that mileage is deductible. Then when he goes from the temporary location to his home, since his main job is in Ridgemont, that is a deductible business expense. Now let's change this slightly and say that Mr. Hand actually has two jobs. He teaches half the day at Ridgemont and half the day at Lincoln. That makes Lincoln his second job. If you look at the chart to the right, you'll see that if you go from home to your first job, not deductible commute. First job to second job, deductible. Second job to home, not deductible. That's considered a commute. Okay, so you can see that there can be some nuances in here and it can be difficult to follow, but you basically just have to follow the rules as they're written. So Stacy works in a public accounting office in New York City, and she typically commutes on the subway. But guess what? During busy season in public accounting, occasionally she works late. In fact, sometimes well after midnight. So is it reasonable, or it is reasonable, to consider her taking the subway after midnight unsafe? As a result, the cost of her taxi home after hours is deductible. This is an exception to that rule, right? She's simply commuting, but because she had to incur this additional commuting cost as a result of what we describe as for the convenience of the employer, because the employer does not want their employee to get hurt, that cost would be deductible. Okay, let's talk about transportation away from home. And when we think about transportation when it's away from home, that's typically airfare, but it could be other forms, right? It could be a bus ticket, it could be a train ticket, it could be a boat ticket. But this is a case where for business, I have to travel away from my home. And that distance, we're not going to worry about the miles, but basically it's far enough that it's not reasonable for you to come back to your house at the end of the workday. So the rules for transportation are different if that transportation is domestic versus international transportation. So if it's domestic transportation and it's primarily for business, your trip is primarily for business, then it's 100% deductible. If it's not primarily for business, then it's 0% deductible. So what's it mean to be primarily for business? Well, typically you'd look at the trip and you kind of add up the number of days you spend on business versus the number of days you spend personal. So if I go on a trip for 7 days and I spend 5 days conducting business, but then I take the weekend and I sightsee and I do some other things, that's primarily for business. It's more than 50% for business. It will be 100% deductible. If I flip that on its head and say, well, I spent 5 days sightseeing and I spent 2 days on business, well, that's less than 50% business. As a result, 0% deductible. If it's international transportation, the rules are different. If it's primarily personal, then none of it is deductible. So if I go on an international trip and I spend 7 days sightseeing and 3 days on business, none of that airfare is deductible, because remember, we're only talking about transportation. If it's primarily for business, so it's more than 50% business, now I have to prorate the cost of that airfare based on the percent business versus the percent personal use. So again, if I went for 10 days and 7 of it was business and 3 of it was personal for sightseeing or whatever, then 70% of the airfare is deductible, 30% is non-deductible personal costs. Naturally, there's an exception to the exception. For international travel, if it's primarily for business and it's less than a week, there's no proration. Or if it's less than 25% personal, there's no proration. So let's go over that first exception right away, because I think it actually makes the most sense. So first off, international travel generally requires a fairly healthy airplane trip. Now, it could be you're just going to Mexico, which wouldn't, but let's assume that you're flying to Europe. So, and it's less than a week. So you're going to fly for 6 days and you do business for 5 days. And there's 1 day that you didn't do business. So it's either to recover, it's to sleep overnight to catch your plane home, whatever it might be. Maybe it's even to sightsee. It doesn't matter. The idea is, look, the Congress expects you to need a day to recover, and it doesn't mean that you have to get right on the plane the second your business is done. So as a result, if it's less than a week, there's no proration. Or if it's less than 25% personal, kind of same idea, no proration. All right, now we can deal with travel. So travel is costs like lodging, your meals, and your incidentals, right? So what are the other costs associated with your travel besides transportation? So if it's related to business, it's deductible. The meals at only 50%. Otherwise, it's not deductible. Oop, so we need to cover that a little more. I thought I would have had more for you. So let's say I go on my 5-day trip, 4 days business, 1 day personal. So I spend a day sightseeing, or I go visit my sister, whatever it might be. So I spend 5 nights in a hotel. Since only 4 of those nights were business related, I can only deduct 4 nights worth of lodging. I can only deduct my business meals on the 4 days that I'm traveling. I can only deduct my incidentals like dry cleaning or cabs or whatever it might be on the 4 business days. That 1 personal day, I can't deduct any of those costs. That's what we're getting at there. Okay, so there used to be this awesome thing called the domestic production activities deduction. And you know, as soon as I refer to it in the past tense, what it means is it's gone. That's correct. The D-pad was repealed at the end of 2017. As a result, this might be the best news you have in this entire video lecture. No D-pad, no quizzes, no exams. You won't see it. It's in the book. As far as I'm concerned, you can just skip it. It might come back someday, but it seems unlikely. Okay, this is the hairiest part of this chapter, and it's not in your book at all. But I did post a great article by Tony Nitti. Tony Nitti writes absolutely fantastic explanatory tax law. He's a tax lawyer from Denver, and he actually spent some time at USD, but he's a great author, and he writes in a very easy to understand style. So if we walk through this and you don't get it, go read the Tony Nitti article. It's not short, but it does a great job explaining it. And frankly, my explanation is based on it. Okay, so here's a flow chart that you can follow that shows how the qualified business income deduction works. And I refer to this, by the way, in Module 1. So this is the pass-through deduction. This is a deduction that's available to pass-through entities, and we'll talk about what the requirements are. Okay, so you might hear it called Section 199A deduction, the pass-through deduction, the qualified business income deduction, or the QBI deduction. And I'm just going to call it the QBI deduction going forward because I can say that fast. So this is available to non-corporate taxpayers as a below the line, so below AGI deduction. And that includes taxpayers who happen to take a standard deduction. So if you look back at those charts I showed you where you calculate corporate income versus individual income, you would see that there was a line for the QBI deduction on there. You won't see that in the book, however, because the book didn't cover that. So the deduction is generally 20% of the taxpayer's qualified business income from a pass-through entity. And a pass-through entity being a partnership, an S-corp, a sole proprietorship, an LLC, whatever it might be, whatever it is that you're passing through that income. What it means is non-corporate income. So what is QBI? QBI is the net amount of qualified income gain, deduction, and loss related to any qualified trade or business of the taxpayer in the U.S. So that means foreign pass-through income is not being considered. What does QBI exclude? Well, notice that it excludes capital gains. It excludes dividend income. It excludes interest income unless you can find a way to properly allocate that to a trade or business. It does not include amounts received from annuities, yeah, whatever. And it doesn't include any deduction or loss that would be allocable to the types of income I just mentioned. So capital gains, dividend, or interest. So QBI is supposed to represent, if you think about it theoretically from a policy perspective, that's the active income, right? It doesn't include those forms of portfolio income, gains, dividends, interest that we covered in Chapter 7. Well, that's okay, right? Guess what? Most businesses shouldn't be mixed up in that. And if they are, it's not the purpose of the QBI to give them the tax deduction, right? It's not the purpose of the QBI to lower the tax rate if you're just invested in stocks and bonds. It's if you're invested in some risky business venture. So the limitation that applies to all taxpayers for the QBI deduction is that it cannot exceed 20% of the taxpayer's taxable income. So, and this taxable income is calculated excluding any net capital gains. Okay, let's do an example. So Linda operates a small accounting business, and that small accounting business generates $60,000 of qualified business income. She also operates a separate investment advising businesses that focuses on providing cryptocurrency investment advice. That thing lost $20,000 last year. Both of these are sole proprietorships. So what Linda has to do is calculate her QBI deduction separately on each activity. So the accounting business is eligible for a $12,000 deduction. That's $60,000 times 20%. Because the cryptocurrency business lost money, she's not eligible for any deduction on that. Linda also earned $5,000 in net capital gains, but she had no other income and no other forms of income, and she just elects the standard deduction. Okay, so in 2018, Linda's taxable income, as calculated under the 20% limit, would be $28,000. That's her $40,000 of business income, right? That's 60 minus the 20, that's the $40,000, less a single standard deduction of $12,000, that's $28,000. Capital gains are excluded, right? Her taxable income would include the capital gains, but for purposes of the QBI limit, those are excluded. As a result, her QBI deduction is limited to $28,000 times 20%, or $5,600. So even though she calculated the QBI deduction as, $12,000 on her accounting business, she's only eligible for a deduction of $5,600. All right, so I only show you this other flow chart because, I don't know, maybe the first flow chart was too busy, maybe it was too complicated, but you can see that this is a calculation that's complicated because all we've done so far is determine what's QBI multiplied by 20%, is it limited by taxable income? But we are not done by any means. There are two additional limitations, the wage limitation and the specified service business limitation. Now again, you may hear these called by different names, although the wage limitation is pretty solidly the wage limitation. You may hear the other one called the service limitation, but neither here nor there. So these two limitations apply to taxpayers that have taxable income, right? That's total taxable income, not just business income, right? Total income above threshold amounts, which are for 2018, $315,000 if you're married filing joint, and $157,500 for all other taxpayers. So guess what? We've dealt with something like this before, right? When we had the passive loss limitation and the Mr. and Mrs. H phase out, we're going to have something similar going on here, right? So they said, look, we want to give this QBI deduction, but we don't want to give it to you if you're uber rich. And we've decided that uber rich is in excess of 315,000 or 157.5 for singles. These threshold amounts, unlike the Mr. and Mrs. H exception for passive losses, they are going to be indexed starting in 2019, which means they're going to change every year. And of course, they're considered before you take the QBI deduction. So to determine whether you're eligible for a deduction, you calculate this without considering the deduction. Otherwise, it'd be cyclical. Okay, so what is the wage limit? Let's start with that one. So it's 50% of the share of W-2 wages with respect to the business. Okay, so that's pretty simple. It's just 50% of the wages paid by that business. So if in our example, I can't remember her name, Linda, whatever it was, had the accounting business, if she paid wages of 20,000, then her wage limit would be 50% of that, or 10,000, which would mean that her QBI deduction could never exceed 50% of that. But it's the greater of that, or what if you're in a business that doesn't use a lot of labor, but you do use a lot of equipment? In that case, it might be the greater of 25% of your wages or 2.5% of the unadjusted basis of all qualified property. Holy cow, you got to be kidding me. No, I'm totally not kidding you. So what are W-2 wages? Well, W-2 wages are pretty easy. That's defined as wages paid to employee, not independent contractors. And that includes any deferrals into things like 401k plans and retirement plans. So you could think of that as your box 3 on your W-2. Qualified property, for purposes of the part 2 of the wage limit, that's any tangible property subject to depreciation for which the depreciable period has not ended before the close of the taxable year. It's held by the business at year end and was used at any point during the year in the production of that QBI. Wow, we haven't even covered depreciation yet, and we're going to have to unpack that just a little bit. So first off, what is the depreciation period? Well, you would think it's the period under which you're depreciating the asset, but it's not. It's the period that's defined as starting when the property is placed in service, so when I start using it, and it ends on the later of 10 years or the last day I depreciate the property. Okay, so let's say I had 5-year property and I depreciate it for 5 years. Even though it's fully depreciated, I get to include its cost in this calculation for up to 10 years because I still own the property. Presumably, I'm still using it in the creation of QBI. Therefore, it's included in my qualified property calculation. So Josh is a single taxpayer. He operates a sole proprietorship. He qualifies for the QBI deduction, but his taxable income subjects him to the wage limitation. And he's purchased and placed in service the following properties, all of which are being used in 2018. So back in 2007, he bought a 5-year asset. Is that qualified property? And the answer is no, because it's clearly past its depreciation limit, right? It would have been fully depreciated, as far as you guys know, by 2012. And it also is past 10 years, right? So we're in 2018. So 2017 would have been the last year that would have been inside its 10-year window. He also purchased a 39-year asset, which, by the way, that's real property, placed in service in 2007. Is that qualified property? And the answer is yes, it is. So it's clearly still being depreciated. It hasn't been 39 years since 07. As a result, it's in qualified depreciation period and it's qualified property. How about 2009, a 7-year asset? Well, it's fully depreciated, but it's within 10 years. And so as a result, it's definitely qualified property. Okay, how about the 2012 5-year asset? So this is one that I'm going to trick you a little bit, unfortunately, because we haven't covered depreciation yet. That one is also still depreciable. It's within, you would find that that's both within its regular depreciation period, even though it's only 5 years. That would be 2017. We're going to find out that it's actually 6 years. But either way, it's still within 10 years, and so it's qualified property. Okay, so now we've determined that we're subject to this phase out. How do we calculate it? So the QBI deduction is subject to a phase out up to an excess of 100,000 for married filing jointly and 50,000 for all others. So think of it as it's going to phase out between 315,000 and 415,000 for married filing jointly. This phase out does not work the same way as the Mr. and Mrs. H limitation phase out. The QBI deduction for this works as a with and without computation. Okay, so how do we do it? So first we compute the QBI deduction with no wage limitation. Then we compute the QBI deduction with the wage limitation. There's the with and without. We measure the excess, right? What is the excess when there was no limitation over the QBI deduction when there is a limitation? And let's call that the excess amount. And then the excess amount is subject to a pro rata phase out based on how much the taxable income was over the threshold amount. And the only way to do this is through an example. Phil's a single taxpayer, QBI eligible small business. Taxable income as measured for the QBI deduction is 177.5. Since he's single, he exceeds the 157.5 threshold by 20,000. QBI is 150,000. His business paid wages of 42,000. And he has qualified property of 660,000. So we have all the parts, we just need to calculate the limitation under the wage limit and then phase it out. So before we move on, just to be safe, if Phil's income was 157,499, he would not be subject to any of this phase out. None of these limitations would apply. The only one that would apply is the taxable income limitation. Since clearly his taxable income exceeds 157.5, he'd be eligible for all of it. So again, we're only talking about this phase out in situations where I exceed the threshold, at least so far. Okay, so Phil's QBI deduction with no limitation. Remember, he had QBI of 150,000 times 20%, that's 30,000. When I apply the limitation, I have to calculate the greater of the two amounts. 50% of his wages, that's 21,000, or 25% of his wages plus 2.5% of his qualified property. That's 27,000. Well, he gets the greater of those two. So his QBI with the limitation would be 27,000. What's the excess amount? That's the no limitation versus limitation of 3,000. His income is in excess of the threshold of by 20,000, right? He had 177.5 minus 157.5 or 50,000. 50,000 is, sorry, he had 177.5 minus 157.5 is 20,000. 20,000 is 40% of his 50,000 phase out range. So 40% of the excess is phased out. That's 1,200 of that, 3,000 excess is phased out, which means his QBI deduction is the 30,000 with no limitation, less his phase out of 1,200 or 28.8. Wow, that's pretty complicated. We're not done. For taxpayers with income in excess of the threshold, certain types of businesses are also not eligible for the QBI deduction. The first is a taxpayer whose business is being an employee. So just to make that perfectly clear, remember we said being an employee was an active trade or business back in Chapter 7? That's true. Just recognize you're not eligible for a QBI deduction. However, the second part is the trap that is designed to catch a lot of people. If you're in a specified service, trade, or business. So the QBI deduction was meant for people who are hiring lots of employees and investing in capital. If you're a service business, you're probably hiring lots of employees, but you're not investing in much capital. And so as a result, if you're in any trade or business involving the performance of services in the fields of health, law, accounting, actuarial science, consulting, athletics, financial services, blah, 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 any of these things, those are considered a specified service business. And as a result, the phase out is applicable to you. Note that architecture and engineering are not considered service businesses under the QBI deduction rules under 199A. Again, service is not precluded from the QBI deduction, but it is phased out. So you can be an accountant. If you are single and you make less than 157.5, none of this phase out applies to you. You get your entire QBI deduction, right? Even if you're in the service business, it's only when you crest those thresholds that it starts to matter. So we got Jenny and Jason filing jointly in 2018. Jenny's a physician and works for her wholly owned S corporation. And that S corporation is going to spit out QBI of $310,000 to her in 2018. The S corporation pays her a wage of $80,000 and it pays her employee wages of $40,000. And all that's already deducted when we got to the $310,000, just so we're clear. Her husband Jason earns wages from his job as a school bus driver, and his wage is $40,000 a year. So when we sit down and calculate Jenny and Jason's taxable income before any QBI deduction, it's $385,000 because she's doing okay as a physician. Jenny's business has qualified property of $300,000. Okay, now we need to apply the phase out to someone who is in excess of the limit, right? Her limit, their limit is $315,000. Their taxable income is $385,000. So they're above the limit. They're in the phase out. We got to figure out what this is because not only are they above the limit, but they're a service business. Okay, so if we were to calculate her QBI without any limits, that's the easiest part. 310,000 was the QBI times 20%. That's 62,000. However, they exceed the threshold by 70,000, 385 minus 315, and they're involved in a service business. As a result, you could think of it as if to say they're subject to a 70% phase out, right? Because they're 70% along the way to a complete phase out. Another way of thinking about it is they're eligible for 30% of the deduction. So that 30% is going to become magical because what we're going to do is we're going to apply the limit using 30% to everything. So her QBI was 310,000. Take 30% of that. Her wages were 80,000 to her, 40,000 to her employees. That's 120,000. Take 30% of that. Her qualified property was 300,000. Take 30% of that. So we've taken 30% of all of those factors we use to calculate the limitation. Now we actually calculate the limitation. So 20% of her phased out QBI is 93,000 times 20% or only 18,600. We compare that to the greater of her W-2 wages times 50%, but only the 30% that matters. 36,000 times 50% is only 18,000. W-2 wages times 25% plus qualified property is the same calculation, but only at the 30% numbers. So we end up with 11,250. So the greater of those two is 18,000. So you'd think at this point, you'd say, well, her QBI deduction is 18,000, but that is not correct. All we've done so far is deal with the wage and wage plus qualified property limitation. Now we have to apply the service limitation. So now we say her QBI deduction with no phase out, recall, was 18,600. Her QBI deduction with the phase out was 18. The excess is 600. That is also subject to the phase out. 600 times 70% is 420. We phase out 420 of the excess. That gives us 180, which means her deduction is 18,180. So all I can think about this is, really, this was going to fit on a postcard? Like, who was thinking this thing was going to fit on a postcard? Because frankly, that's just not realistic. Okay, wow, we're still in chapter 9 and still going. This thing's going to take forever. Accounting methods. So, economic income. We recognize all gains and losses, whether they're realized or unrealized. So, Jose buys stock on the first day of the year for $10. On the last day of the year, the price has risen to 25. We already know there's been no realization. So does he have income? Oh yeah, he's definitely better off, right? I mean, the shares of stock are going up by $15. But can we tax that income? Well, we could, but since he's still holding the stock, how's that match up with the ability to pay? Well, it doesn't match up well at all. So as a result, no realization event, no income for tax purposes. We have income for economic purposes, but not tax. Well, let's think about it from an accounting perspective. Would Jose have accounting income? Well, that might depend, because the GAAP rules now include all sorts of information that considers the relevance over its reliability. So you should be aware that there's mark-to-market accounting, right? And it could depend on whether it's held for sale or whether it's held to maturity. But the reality is there might be accounting income there. And even if it's not accounting income, it might be other comprehensive income. So accounting might recognize that as income, because that sort of trade-off is appropriate for that environment, right? That involves lots of management intent and lots of judgment. But the objective of measuring taxable income has nothing to do with that at all. It's simply to raise revenue. The raised revenue model would imply the economic income model, which is, hey, the second you have economic income, we want to tax it. But we know equity is based on the ability to pay. So what happens is when cash becomes available, very often the code will call for taxes. I call that the Vegas mushroom paradigm. So what that means is, as a result of the transaction, if you walk away with cash in your pocket that you can go to Vegas and buy mushrooms, then there's a pretty good chance it's going to be taxed. Now look, no book uses this paradigm. Oh, it's only my word, but we'll use it over and over and over again, and you'll probably get used to it. So the idea is this totally attempts to avoid issues of judgment and intent. Well, how are you holding the investment, Jose? Are you holding it till maturity, or is it available for sale? Tax code doesn't care, right? They basically say, look, I don't care what your intent is. For the most part, intent's a black box. You have a realization event or not. So we realize and recognize income at many different times, right? So when do I incur sales? When do I sell property? I can do it all amounts of times, but we need to lock in under a period under which we can report this. And from an accounting perspective, you guys are used to this, right? We could have chosen a daily, weekly, monthly, a quarterly period like the SEC does, an annual period like GAAP does. The IRS went with yearly. They basically said, look, we're going to ask you to measure your realization and recognition transactions on a yearly basis. And individuals file tax returns for a calendar year-end period. Corporations can use a fiscal year-end. They can also use what's known as a 52-53 week year-end, but that's pretty rare. But in either case, whatever your method of accounting is going to determine the year in which realized income becomes recognized and therefore included in gross income. So flow-through entities have some flexibility in terms of the year end. So they could pick one, but they could be in the calendar year end, but they could be in other year ends as well. And timing matters, you guys. Terry's a real estate broker. She just identified a buyer for LaDainian Tomlinson's house who's going to pay $3.5 million. Her expected commission on that sale is $105,000, and it's going to be the only house she sells this year. So the question is, should she schedule the closing for December 31st of this year, or maybe January 2nd of next year? And we know from the timing variable that if she defers it for just a couple days, she doesn't have to pay tax for a whole nother year, right? So timing matters, and her ability to control that timing is at play here. So 446 provides the general rules for when you recognize income. And it says taxable income shall be computed under the method of accounting on the basis of which the taxpayer regularly computes his income in keeping his books. However, there are exceptions. If no method has been regularly used, or if the method does not clearly reflect income, then such computation of taxable income shall be made under such method as, in the opinion of the Secretary, which is the Secretary of Treasury, does clearly reflect income. Okay, so that's a lot of legalese, but it's really important, because what it means is if you use your regularly computed method of income in keeping your books, you're probably going to be okay. But if you're not using a method, or the method you're using does not clearly reflect income, then the IRS has the right to tell you what does clearly reflect income. And that is a situation you simply don't want to be in as a taxpayer. You want to know that your accounting is clearly reflecting income, because the last thing you want is the IRS to come in and make that determination for you. Okay, so what kind of permissible methods are there? So the IRS says, well, look, you can use the cash method, you can use the accrual method, you can use any other method permitted by this chapter, which means any other method we tell you you can use, or any combination of the foregoing methods that's permitted under the regulations. And there are no other methods, right? Sometimes they talk about the hybrid method as being another method. That just means you're using cash for part of your business and accrual for another part. So there are limitations on the use of the cash method. Not everyone can use the cash method, though almost all individuals do. For example, a C corporation, a partnership with a partner that's a C corporation, may not use the cash method. However, there are exceptions if you're a small business. So it used to be that the small business rule was if your gross receipts were 5 million or less, but now they're up to 25 million. So that means a business that has gross receipts of 24 million can keep their books for tax on the cash method. Now, what I would tell you is that doesn't make any sense. We all know under all these GAAP rules that we've been taught that accrual-based accounting is a much better way to measure the profitability of your business. And if you have a $24 million business, are you really going to keep it on a cash basis? Probably not, but you could under tax law. Okay, so a qualified personal service corporation is also an exception. So remember those businesses that we saw that were specialized service businesses under the QBI deduction? Those same ones are qualified personal service corporations. And notice that engineering and architecture is included in this group, and they can use the cash method no matter how big they are. So that's right, Pricewaterhouse, one of the largest, PwC, one of the largest accounting firms in the world, well in excess of 25 million, uses the cash method to keep their books. Okay, so companies with inventory must use the accrual method, right? So the rules say that if you keep inventory, you have to use purchases, cost of goods sold, you have to take, year-end inventory, this sort of thing. And there used to be a couple exceptions under a couple rules, a revenue procedure that were built for small businesses. But again, the Tax Cuts and Jobs Act expanded that and said, look, we're just going to say that $25 million gross receipts test, that applies to having to keep inventory as well. So if you're less than 25 million in gross receipts, you no longer have to keep inventory on the accrual method. But your inventory still must clearly reflect income. And there's a safe harbor that they provided that said, look, obviously keeping it on the accrual method clearly reflects income. But if you don't want to do that, you can treat it as if it's non-incidental materials or supplies, or whatever you do for book purposes. So that's a pretty good rule. So if you keep it under some other method for book purposes, boom, you're done. If you don't keep it under that method for book purposes, then you better treat it as you better treat it as non-incidental materials and supplies. Okay, so when we think about costing our inventory, let's flash back to our cost accounting. And remember that the cost of inventory is really direct materials plus direct labor plus overhead. And recall that overhead is where all those allocations occur, right? Maybe we use a general method, units of production, maybe we use activity-based costing, but whatever we do, we're taking that overhead, factory rent, utilities, and we're determining what part of that belongs in inventory. That's just cost accounting. Well, the tax rules are very specific on overhead allocation methods. And UNICAP, or Code Section 263 Cap A, is well beyond the scope of what we need to cover in this course. I covered that in the corporate accounting course as a graduate student. But know that this specific allocation method that the tax rules require almost always results in more overhead being capitalized into the cost of inventory than for book purposes. Okay, so in the first year, let's assume this company sells no inventory. And if we look at their total overhead, they've got factory salaries, salary admin, raw materials, and factory overhead for a total product cost of $26,000. If I look at it for book purposes, I say, okay, all the factory goes into inventory. Only a third of the admin salaries are going to end up in inventory. Raw materials, that all goes into inventory. Of the overhead, looks like 3/7 ends up in inventory for book purposes. So my total cost of inventory for book purposes is 18,000, which means that the remaining 8,000, so the 26 minus the 18, those must be period costs, and I just expense those as incurred. However, under UNICAP, since the tax law almost always forces you to capitalize more costs than you get to deduct, I end up putting more of those overhead costs into inventory. Notice that the admin salaries are 4,000 ends up in inventory instead of 2,000. Factory overhead, all of it ends up in inventory instead of just 3,000. So as a result, my total inventory cost is 24,000. My period cost is only 2,000. So I have a book tax difference. So for those of you that have taken Professor Machado's course, you know, I have a temporary difference of $6,000. And the difference is in my balance sheet. The inventory for book purposes says I have 18,000 of inventory. Inventory for tax purposes says I have 24,000 of inventory. If I turn around and sell all that inventory, then it all flushes through cost of goods sold. And notice that the cost will be the same over both years, whether I recognize it as a period cost or a product cost. When I flush out all my inventory, I eventually recognize all of it. It's just a temporary difference, but that temporary difference will make a difference in my calculation of taxable income under 263 Cap A. Okay, so just for those of you that are curious, I won't really demand this of you, but if you wondered how you cost non-incidental materials and supplies under that safe harbor, you can deduct the cost in the year you pay them or the year they're consumed or used by a customer, whichever is later. So that's just a quasi-accrual-based accounting, but it's still pretty similar. Okay, now we get to shift to income for a little bit. So we know gross income is income from whatever source derived. Taxpayers realize and recognize income, which means they report it on their tax returns for the year. If it's not excluded or deferred, which means it's not included in gross income, then it's not recognized. Gross income includes a deduction for cost of goods sold. This is all redundant. We've all covered this before. Gross income is very broad. All sources, any format. Okay. 451 says gross income will be included in the taxable year in which received by the taxpayer, unless the method in computing taxable income for such amount is properly accounted for as of a different period. I'm not sure that helps us at all, other than to say you include it when it's received by the taxpayer, unless it should be accounted for in a different period. So we need to be more specific. So if we need to be more specific, we need to break down taxpayers into two types, cash basis or accrual basis. A cash basis taxpayer, under the tax law, income will be included in gross income in which it's actually or constructively received. Hey, we covered that back in Chapter 5's lecture. It's constructively received when all these things happen. It's not constructively received if it's subject to substantial limitation. We had already covered that, so I skipped through it. Accrual method. Under the accrual method of accounting, when I include income is recognized when all the events have occurred which fix the right to receive such income, and the amount can be determined with reasonable accuracy. Okay, that's great. What does it mean when all the events have occurred which fix the right to receive income? Well, the Supreme Court decided what that was because Congress didn't write it. And they said that's going to occur at the earliest of the income is earned. Okay, well, we get that, right? You've covered that in revenue recognition and your financial accounting. When income is earned, it's also earned for tax purposes. When the payment is due, well, wait a second, that's a little bit hairy. Or worse yet, the payment is received. So if you receive a payment under the claim of right doctrine and under the all events test, that is income to you. It's that last one that really hurts. So let's say you buy a Cheesecake Factory gift card for your friend for the holidays in 2017. And your friend sits on that gift card and goes to the Cheesecake Factory in 2019 and pays for the gift card. So when we think about the Cheesecake Factory's accounting for that gift card, in 2017, you buy the gift card. So Cheesecake Factory gets cash, credits deferred or unearned revenue, right? This is just some classic financial accounting. In 2018, nothing happens, so you don't do anything. In 2019, you now recognize the revenue by crediting revenue and debiting that unearned revenue liability account, right? That's just some classic accrual-based accounting. And it makes sense because what else happens in 2019 is you recognize the costs associated with delivering the food to the table. Tax accounting under the all events test says that I recognize income when all the events have occurred that fix the right to receive it and it's reasonably estimable. So in 2017, did I receive the cash? Yes. Bummer. Debit cash, credit revenue. What do I do in 2019? That's when I recognize the expense. That provides horrific matching under the tax rules. But that is in fact the rule under the all events test. The general rule says you recognize advance payments when they are received. So we need to have a deferral election because we see that this matching that's required under this Supreme Court case is terrible and doesn't make any sense. So there are two ways of deferral. The first is the old pre-28 way. And there were two flavors. You could defer on the sale of goods or you could defer on the sale of services. And the rules were different and they weren't super complex, but they were different and that made it worse. Now we're in the post-2017 era. Under section 451C, which is a brand new code section, we can defer advance payments for up to 1 year. This overrides those previous two ones. It also states that you must recognize revenue no later than you recognized it in your applicable financial statements. And of course, you can always still recognize it under the all events test if you prefer to accelerate its recognition. Now, we know from Module 1 that we prefer to defer income and accelerate deductions. So by recognizing under the all events test, you would be accelerating the recognition of income, which generally goes contrary to what you want to do. November 1st, 2018, Arnold receives a $4,800 advance payment for a 1-year contract to provide dance lessons. In 2018, he provides 8 lessons. And then in 2019, he provides 40 lessons. Arnold recognizes the income pro rata for revenue on his books. If Arnold chooses to defer for tax purposes, how much does he have to include in both 2018 and 2019? So in 2018, he wants to defer because he received an advance payment, but he can never do it later than he did for financial statement purposes. So for financial statement purposes, a 1-year contract for 48 lessons, it's $100 a lesson. 8 times $100 is $800. So in 2018, he recognizes only $800. So that would basically match his book accounting. In 2019, he has to recognize the entire remaining deferral of $4,000. So it doesn't even matter that the rest of the lessons were in fact given in 2019 and earned. Whether they were earned or not, he has to recognize the entire remaining deferral. So let's play with that, except let's say it's 96 lessons over 3 years. And he's going to recognize a 12th in 2018, 5 12ths, sorry, I can't read all my math because you guys are in the way. 6 12ths in 2019, 5 12ths in 2020 for book purposes. So how much for tax? So for book purposes, it's ratable. 1 12th, 11 12ths, 0 12ths, right? Sorry, for book purposes, it's ratable. For tax purposes, 1 12th in 2018, because that's what he did for book. He cannot defer past the 2nd year, so the entire remaining amount is recognized in 2019, with none of it being recognized in 2020. All right, just so you know, prepaid interest and rent are always income. So even if you receive an advance payment of prepaid interest or an advance payment of prepaid rent, you get no deferral on those. It doesn't matter how bad the matching is. You just got to take them to income, accrual or cash-based taxpayer. There are some rules under Code Section 467 about rent. That's well beyond the scope of this course. Again, I teach it in the corporate graduate course. All right, deductions. What about the timing of deductions? So we don't get a lot here either. 461 says you take the deduction in the taxable year for the that's the proper taxable year under the method of accounting for calculating taxable income. Okay, great. That simply says that if I use income for if I use cash basis for income, I need to use cash basis for deductions as well. So under the cash method, when do I recognize a deduction? Well, how about when it's constructively paid, right? If we recognize income under constructive receipt, is there a constructive payment? The answer is there is not. So the basic answer under the cash method is you recognize a deduction when you pay it, period. It's as simple as that. So on December 31st, 2018, Wendy pays her business insurance premium. And the period for the insurance is January 1st, 2019 to December 31st, 2019, and it costs her $12,000. So if you think about the book accounting for this, in December, that's prepaid insurance, right? So I debit prepaid, I credit cash, and I'm going to amortize that over the life of the policy. So this is because I'm capitalizing that cost, right? By setting up a prepaid, I've capitalized the expenditure, and then I'm going to amortize that capitalized cost over the life of the policy. And I would do that for book accounting. Now, I could do that for tax accounting as well, because when an expenditure provides a benefit beyond the end of the taxable year, you're supposed to capitalize that for tax purposes. However, there's an exception. The exception is called the 12-month rule. And it says if you have prepaid expenses and the benefit is going to be equal to or less than 12 months, and the benefits do not extend beyond the end of the next tax year, then you can go ahead and deduct all of it. The 12-month rule does not apply to interest. Let's do an example. Okay, on December 1st, Mighty Mart pays a $10,000 property insurance premium for a 12-month term that starts December 15th of 2018. So does it extend beyond the earlier of 12 months after the first date on which the taxpayer realizes the right? And the answer is no, it actually is exactly 12 months, right? It's a 12-month insurance policy. It goes from 12/15/2018 to presumably 12/14/2019, right? So it's exactly 12 months. Does it extend beyond the end of the taxable year following the taxable year in which the payment was made? Okay, when was the payment made? The payment was made in 2018. What's the end of the taxable year after that? Well, that's after 2019. Does the insurance policy extend beyond 2019? Well, no, it ends in 2019. As a result, I can deduct this payment under the 12-month rule. Exact same example, right? So the Mighty Mart CFO gets smart and says, oh, I see. If I pay this early, I can deduct all of it. So there's a different policy premium that they want to pay $10,000 on. This one doesn't start in 2018. It starts in 2019. Okay, so does it extend beyond 12 months? No, again, it's a 12-month policy. So it's exactly 12 months, so it meets the first hurdle, but does it extend beyond the taxable year following the year in which the payment was made? Okay, the payment was made in 2018. Does the policy period extend beyond the end of 2019? In this case, it does. As a result, the 12-month rule cannot apply. This prepaid needs to be capitalized and will be amortized over the life of the policy, just like it would be for book purposes. So the 12-month rule is basically an escape hatch for a cash basis taxpayer that allows them to deduct something when it's paid, even though it creates a prepaid. So the idea is, we really don't want basic taxpayers having to track prepaid assets. How about accrual-based deductions? An accrual-based deduction, so a taxpayer can deduct an expenditure when all events have occurred that establish the fact of the liability. It can be determined with reasonable accuracy, and economic performance has occurred. Okay, so both income and deductions for accrual-based taxpayers are based on something called the all events test, right? For income, it was when all the events have occurred that establish the right to receive. In this time, it's all the events have occurred that establish the fact of the liability. But they've tacked on something extra, right? If I want to accelerate deductions and the IRS wants me to slow down deductions, then adding an additional rule is likely to slow them down. And that's exactly what's happened here. And economic performance has occurred. Okay. Economic performance is defined 4 different ways, and it depends on the underlying transaction. So if it's for services and property provided to a taxpayer, which the vast majority of expenditures are for, by the way, right? I'm either buying goods or I'm buying services for my business. Those are deducted when they're provided to me. That's kind of classic GAAP accounting, right? If I buy goods, when are they provided to me? When title transfers, right? That's when I get to recognize the deduction as well. When property is used by a taxpayer, that's things like rent. So if I rent a building, when can I deduct the payment I make for rent? It's as I use the property. That's when economic performance occurs. Services and property provided by a taxpayer occur as such services or property are provided. We're going to do an example of that one because that's weird. When you think about it, when do you get to deduct costs? When you're providing services, but I'll show you an example. And then everything else falls within the category of payment liabilities. So payment liabilities, economic performance occurs when the payment is made. So all those other rules, when is service provided, when does use occur, none of that applies to payment liabilities. Economic performance occurs when the payment's made. The fourth catch-all is everything else, and currently the regulations say everything else is treated as a payment liability. Okay. So Captain Hook Corp is a calendar year-end corp. They purchased napkins and other incidental supplies in December of 18. They're billed in 19, and they pay for them in February of 2019. Okay, so that'd be a classic kind of case, right? They buy it on credit, right? They're billed in 19. They pay it within 30 days, so it gets paid in February of 19. So they're a calendar year-end corporation. Let's assume they're a small business, and they could be a cash basis if they wanted to. So if the supplies were delivered in 2018, when will Captain Hook deduct the cost of these supplies if they're a cash basis taxpayer? So a cash basis taxpayer, what is the rule? When paid. So a cash basis taxpayer, it doesn't matter when the supplies were delivered. They were paid in February of 2019. That's when they're going to be deducted. If you're an accrual-based taxpayer, then it occurs when the right to fix the liability has occurred and economic performance has occurred. Okay, so what is the type of transaction? It's an expenditure for goods being supplied to me as the taxpayer. So when does economic performance occur? When the goods are provided to me. When did that occur? December. An accrual-based taxpayer deducts this in December, even though they don't pay for it until February. That's just accrual-based accounting. Okay, what if the supplies instead had been delivered in January of 19? If you're a cash basis taxpayer, does that change anything? Doesn't change a darn thing. You deduct it when you pay it. That's in February of 19. If you're an accrual-based taxpayer, however, now that changes things because economic performance doesn't occur until January of 19. As a result, as an accrual-based taxpayer, that's when you would deduct the cost, January of 19. All right, Captain Hook also leases the building in which it operates. In November of 28, let's see, it pays for 12 months of rent for the period December 1 through November 30, 2019. How much of the rent can Captain Hook deduct? If he's a cash basis taxpayer, you'd say, well, it's when it's paid, right? So he pays it all in November of 2018. He deducts all of it in November of 2018. Does the 12-month rule apply? Because technically it extends beyond the end of the taxable year, right? So you'd say, okay, well, let's apply the 12-month rule. The 12-month rule says, does it last for more than 12 months? No. Does it extend beyond the end of the year after which I made the payment? So does the rent period extend beyond 2019? No. As a result, I can deduct it under the 12-month rule. If I'm an accrual-based taxpayer, however, the 12-month rule doesn't apply because economic performance has to apply. When does economic performance apply with respect to the use of property? It applies over time. As a result, capitalize, amortize that rent every month, 1/12. All right, services and property provided by the taxpayer. I told you I'd give you an example of this, so here it is. So you accrue that cost as services and property are provided. That's when economic performance occurs. So let's say Colbert enters into a contract with the city to remove a wall for $1,000. And Colbert says, you know what I've realized? I want to deduct this cost right away. I want to reduce my taxable income. So I'm going to go ahead and pay a subcontractor $800 in December of 16. Then the subcontractor doesn't get around to removing the wall until May of 2017. So when can Colbert deduct that cost? Not until the services and property are provided, which means that doesn't happen until May of 2017. So even though paid in 2016, as an accrual-based taxpayer, not deductible until May of 17. All right. What about payment liabilities? This is our last little area here. So payment liabilities, you accrue them when they're paid. So I can deduct it when it's paid. So what fits within a payment liability? Any liability that comes from workers' comp, a tort, which is a lawsuit, a breach of contract or violation of law. Any rebates and refunds are accrued when paid. Awards, prizes, and jackpots are payment liabilities. Insurance, warranty, and service contracts and taxes. These are all payment liabilities. So you deduct, or I shouldn't say that, economic performance occurs when they're paid, which typically means you deduct them when they're paid. Like all good tax rules, this one has a bevy of exceptions. So the first exception is the 3.5-month rule. The 3.5-month rule says if payment is made for goods and services to be provided to the taxpayer. Okay, so let's make sure we understand the limitations on this exception. Has to be for goods and services, has to be for provided to the taxpayer, and the taxpayer reasonably expects those goods and services to be provided within 3.5 months of the payment. They can go ahead and treat it as if economic performance occurs on the date of payment. So the classic case for this used to be postage machines. It used to be that what would happen is you had a postage machine in your office provided by Pitney Bowes, and you sent Pitney Bowes a check, and they put postage on your machine. And then you just used a stamp machine provided by them, and you posted all your letters. Well, because you paid for it in advance, and you knew you had to refill it every quarter, you could go ahead and deduct that cost because you would reasonably expect the postage to be used within 3.5 months. So if I can expect economic performance to occur, then I can go ahead and deduct it. That's the first exception. The second exception is the recurring item exception. This one is a little broader in some respects and a little narrower in other respects. If the all events test is met, then economic performance will have been deemed to occur if actual economic performance does occur within 8.5 months. So that's a long time, and the item you're accruing is recurring in nature, and it's not material. Okay, so the recurring item exception allows you to use your year-end accruals that you accrue over and over and over again. Typically, the one I think of is the utility bill. Like I accrue my utility bill at year-end and then I pay it after year-end. Well, that's a recurring exception. I'm going to do it every year. I certainly am going to use the electricity next month. It's probably not material to my business, and as a result, I can go ahead and deduct that cost. Okay. So there are exceptions for related parties. So an accrual-based taxpayer may not accrue costs to a cash basis related party taxpayer until they're actually paid. And the big exception for this is if a corporation accrues a bonus to one of its shareholders, it's not allowed to deduct that bonus until it's actually paid because he's a related party. All right, one last section in Chapter 9, and then I need to take another 3-minute break, and then we'll come back. So accounting methods are generally adopted by their use, and a permissible accounting method is adopted by using and reporting that method for 1 year. So let's say that the method I want to use is I'm going to defer my revenue under the rules we just talked about on advance payments. It's an allowed method, and I use it in the first year. Now I've adopted that method, and I use it from here on out. If, on the other hand, I adopt an impermissible method, so maybe the impermissible method is I'm using the recurring item exception on something that's not recurring. And I've done that a couple years in a row. If I use it 2 years in a row, that's also adopted. And the reason that matters is once you've adopted an accounting method, to change that accounting method, you have to ask the permission of the IRS. Now, some changes are automatic. So, for example, the tax law just made a bevy of changes to the rules. Generally speaking, the IRS will send out a revenue procedure that says changes that are subject to those that are just as a function of the fact that we changed the tax law, they're automatic. You don't need to ask for our permission. Permission is always necessary to correct the use of an impermissible method. So basically what you're saying is I have to go to the service, I have to tell them that I'm using an impermissible method and that I want to change it to the right method so that they can audit me for those years. And the reality is if I wait until I'm audited and then I'm caught, I cannot ask for that permission to change any longer. So the rules are there kind of to be like, look, you better report yourself or else it's going to get worse before it gets better. So if you go through an accounting change, what you have to do is measure the cumulative difference since the beginning of time. That's your 481 adjustment. If it's positive, meaning if it's income increasing, they actually let you take it in over 4 years. If on the other hand, it's income decreasing, right, which is good, that lowers your taxable income, then let's take it immediately. That's pretty good rules. Okay, that brings us to the end of chapter 9.